In this video, I'll take a look at a recently added trading idea that was developed specifically to identify high-quality companies. And we are proud of it. In fact, we might even say that what is covered in this video is currently the most comprehensive and sophisticated screen you will find on the World Wide Web when it comes down to screening for pure quality stocks. But what exactly are quality stocks, and how does the quality investor differ from investors who focus on growth or valuation? The most important thing, as the name suggests, is the quality of the company in which one invests. That quality manifests itself in very solid companies with an outstanding track record over a period of at least 5 to 10 years and a healthy financial balance sheet. The track record reflects strong organic and stable sales growth and similar profit margins. A characteristic of such quality companies is that they convert a large portion of realized profits into free cash flow. Thereby, return on invested capital is one of the most important parameters by which true quality companies stand out from the rest. Unlike the typical growth investor, the focus on the quality investor is much broader. While growth is a structural component of quality investing, companies must also be profitable. When comparing quality investing with value investing, the difference lies mainly in the price both are willing to pay for the stock. The value investor will only buy the companies he has his eye on if he can do so at a cheap price. The quality investor is less stingy. He is even willing to pay a premium because, after all, quality costs money. That does not mean, however, that every price is justified. Valuation does play a role, but the quality investor is willing to pay a correct price. In other words, they are not looking for reasonable companies at great prices, but rather great companies at reasonable prices. The trading idea discussed in this video is called the Caviar Cruise. These are two terms associated with wealth, but it is mainly a reference to the Belgian investor Luc Kruse, author of the book The Caviar Formula. Luc Kruse has been active in the stock market since 2008 and he is a full-time professional investor, a real estate investor and financial blogger since 2014. His book, The Caviar Formula, focuses on 13 carefully crafted criteria to identify companies that perform consistently well. Unfortunately, the book is currently only available in Dutch. In this video, however, I will discuss all the criteria and ratios used quite extensively. Keep in mind that not all criteria for quality investing are easy to grasp or objectively quantifiable. In this first part, I will delve deeper into what is quantifiable, the pure numbers. The second part will elaborate on the qualitative parameters. Remember that both parts are equally important. One of the foundations of the screen is to retain only those companies with a track record of years of revenue and profit growth. After all, quality companies can be recognized by their outstanding historical results over the past 5 to 10 years. As always, past results are no guarantee for the future, but there is no doubt that a company with a strong track record of past performance will also do good in the future, especially if you also consider the qualitative criteria. The primary measure of historical performance is revenue growth, the total number of goods and/or services sold in a given period multiplied by the selling price. Only stocks that can show an annual sales growth of at least 5% over the last 5 years are included. In the screener, select the Fundamental tab and choose Revenue Growth 5 years at least 5%. In addition to revenue growth, profit growth is also taken into consideration. To estimate this profit growth, it is important to look at the right figures. The gross profit gives a picture of what remains of the profit after all costs related to the product are deducted. The operating profit, the earnings before interest and tax, is obtained by including all operating costs such as wages, rent, depreciation and development and/or marketing costs. Finally, to arrive at net profit, taxes and other financial liabilities are also taken into account. When the net profit is divided by the number of shares outstanding, you obtain the earnings per share. The author points out that while gross profit says something about profitability, it says nothing about the cost of doing business itself and whether or not it is done efficiently. Net profit, on the other hand, makes it difficult to compare companies globally. Depending on the type of industry or sector to which the company belongs, the capital structure is quite different and, in addition, different tax rules apply in different countries. So ideally, we look at EBIT growth to compare companies in their core operational activity. And we use the EBIT growth filter and determine that growth should be at least 5% annually. In addition to pure revenue and profit requirements, we also require that profit growth exceed revenue growth. Firms that succeed in this are likely to enjoy economies of scale, or they have pricing power that should not be underestimated. To define this parameter, we need to use a custom filter that states that EBIT 5-year growth is bigger than revenue 5-year growth. The extent to which realized profit is converted into free cash flow tells us something about the quality of that profit. The less of the accounting profit translates into effective cash, the lower the profit quality. In the case where the entire accounting profit is converted into cash, we have a profit quality of 100%. That profit quality is easy to calculate by dividing free cash flow by net profit and then multiplying it by 100. The higher the percentage, the higher the profit quality. In the stock screener, the profit quality parameter is available as a filter, so you don't have to calculate anything yourself. We use an average of 75% over a 5-year period. Return on invested capital is the most important parameter in this screen. Indeed, this ratio tells how efficiently a company uses its capital and manages its balance sheet to generate profits. Obviously, a company that makes 30 cents of profit on every dollar invested is more attractive than one that generates only 6 cents on profit. A sufficiently high return on invested capital is very typical of quality companies. High returns also ensure that capital requirements are contained and the need for external capital is much less present. In this respect, this ratio is closely related to the level of sales growth that we discussed first. Part of the profit can then be reinvested in the company. Companies that reinvest their profits in this way instead of distributing them as dividends ensure that their assets grow exponentially. That's because the assets on which the return is earned continue to grow. You can compare it to a snowball rolling down the mountain and getting bigger and bigger because as the snowball rolls, more and more snow sticks to it. There are several ways to calculate return on invested capital, but it would lead us too far to go into detail. However, there is an article available on the website that explains the different calculation methods in more detail. And ChartMill is the only stock screener that offers 3 variants of return on invested capital. The classic one, including cash, goodwill and intangibles. Then a version excluding cash but with goodwill and intangibles, and a naked version without cash, goodwill and intangibles. And for the Caviar Cruise trading idea, we use the most operational return on invested capital version. That is, without cash, goodwill and intangibles. It should be at least 15%. In order to get a good picture of the debt position and estimate to what extent the debts are effectively manageable, the following filter compares the debt to the free cash flow. We already knew that free cash flow is the portion of cash that can be taken out of a company each year after all costs, liabilities and investments have been dealt with. That money can then be used to pay dividends to shareholders or to buy back shares, for example. Alternatively, that money can be used to finance acquisitions or pay off debt faster. This ratio shows how many years it will take to repay all outstanding debts with the current free cash flow. 0 to 5 years is a good acceptable ratio for quality companies. A higher figure indicates some danger and ensures that you will have to dig further into the numbers to find out what the exact cause is. The above 6 filters form the basis of the Caviar Cruise screen. There are a number of optional filters which are not part of the basic screen. You can use these to get an even better picture within the initial selection about the debt ratio and the extent to which the company is investing in further growth. The debt to free cash flow ratio is already used in the standard screen to get an idea of how manageable debt is and remains. However, it says little about the effective debt ratio. In the most ideal circumstances, a company has little or no debt. Yet, it is far too short to say that going into debt is always negative. Wanting to avoid debt at all costs can lead to important growth opportunities being missed precisely because the capital for it is not available in the company. It all comes down to handling debt wisely and making sure that it does not immediately become a major problem as soon as things slow down. Even with debt, the company must still ensure that the financial balance sheet remains healthy. A debt ratio of more than 100% means that the company has more debt than equity, and as a pure quality investor, you may want to avoid these companies. To avoid companies carrying too much debt, you can use the debt to equity filter in the stock screener and set it to maximum 1. The current and quick ratios are both liquidity ratios and tell something about the extent to which a company is able to meet its short-term obligation with its current assets. These are all the assets in a company that are relatively easy to convert into cash within a 1-year time frame. The difference between the current and quick ratio lies in inventories. While these are counted as current assets in the current ratio, they are not in the quick ratio. The quick ratio may be appropriate for firms that keep a relatively large inventory in order to get a slightly more accurate picture of their liquidity position. In practice, inventories are worth less than what is on the books. Both the current and quick ratio are available in ChartMill. A ratio between 1 and 2 is recommended. Cash only becomes valuable in 2 ways. The first way is by distributing the cash to shareholders. The second way is when the cash can be reinvested in projects that yield very attractive returns in the future. Figuring out whether a company is investing only to safeguard the current state of the business or whether it is actually making growth investments is rarely just inferred from the cash flow table. To find out just that, you can plot capital spending against depreciation. After all, what is depreciated will have to be replaced. The formula for this is simple. Capital expenditure is divided by depreciation and then multiplied by 100. A ratio equal to 100 then means that the company is investing primarily to maintain existing operations. For example, a work equipment rental firm has 8 large racks in its supply. These are depreciated over a number of years and eventually need to be replaced. The racks that are then purchased to replace them are maintenance investments. However, if the firm decides to increase the number of large racks in their supply, because it appears that demand regularly exceeds supply, and purchases 5 additional racks to arrive at a total of 13 for rental, then these purchases are growth investments. Investment intensity rates higher than 100% thus indicate growth investments by the firm. We have already converted the formula described above to a specific ratio available in the platform. CapEx depreciation. The CapEx depreciation is especially interesting as a verification if the earnings quality previously addressed is lower than 75%. Why? Well, we talked earlier about the earnings quality ideally being higher than 75%. However, that does not mean that a lower profit quality is necessarily a bad thing. This lower score is perfectly justifiable if the company invests significantly to grow. The free cash flow will be lower, which, by the way, is the reason for the lower profit quality, but if the investments results in returns well above the cost of capital, then that is a very good thing for the company and the shareholders. In addition to the basic screen, we also provided an advanced version where a number of additional parameters were retained. This makes the selection even more stringent. What remains are companies whose profit margin, operating margin, and return on invested capital have increased over the past 5 years. The companies that succeed in this are thin on the ground, but such results are evidence of good and efficient management. It is also an indication that the company in question has a number of notable strengths that firmly establish their competitive position within the industry or sector in which they operate, as well as having pricing power that should not be underestimated. Of course, we want such companies to be able to present rising sales figures in the future as well. The past is and remains a good indicator of this, but we also look at what the experts and analysts say about future prospects. To this end, we use the revenue next year filter, and the revenue next 3 years should be above 5%. As I already mentioned, the advanced filters cause the list of potential quality stocks to decrease significantly. This in itself is not a bad thing, but there is a risk that a number of interesting companies will be eliminated. After all, the filter settings do not allow for nuance. Either a stock meets a specific parameter or it does not. The result of a growth filter over a specific period is only an average and does not necessarily say anything about the underlying trend. The point at which the measurement begins, for example, an exceptionally strong starting year can cause the current value to be lower, while the underlying trend is still stable. The reverse is also true, of course. Outliers always have a significant impact on the final result. One really bad result due to an unexpected event, for example, can have a pernicious impact on the average result over the last 5 years, preventing the stock, based on the configured filter, from being retained. To avoid this, it is appropriate to also examine exactly which companies dropped out after an advanced filter was added. For example, suppose you added the filter profit margin growth 5 years bigger than 0% in addition to the basic screen. causing a number of companies to disappear from the list. To still be able to view those specific companies separately, it's sufficient to add the reverse filter to the basic screen. So you replace the additional advanced filter, profit margin growth 5 years above 0%, with profit margin growth 5 years lower than 0%. This will now only show you the companies that were just dropped, and you can examine these more closely and find out which companies, if any, were filtered out incorrectly. In this video I have set all filters manually, but of course that is not necessary. From the trading idea page you can very quickly select the basic or advanced screen and view the results individually. You can choose to apply the filters to the entire database or select a specific region. There you go, that completes this video. Questions and/or comments may be posted below the video. And all that remains for me is to thank you guys for watching and to give us a big thumbs up and become a member of this channel if you liked the video. I hope to see you next time.